All right, guys, so today we're going to go over how much house a mortgage lender will allow you to qualify for when making a $150,000 salary in the Bay Area. We'll go over 4 different scenarios with different debts and down payments to also give you an idea of how your debt and your down payment can influence your buying power. And all of these examples are going to be assuming a 740 plus credit score with a conventional loan program. So lenders and banks, the way they determine how much you're going to be able to qualify for is based on your debt to income ratios. And so what that means is that the underwriter wants to see that your monthly debt payments don't exceed more than 50% of your gross monthly income. So if you owe $20,000 on a car loan and $10,000 on a credit card, that's not necessarily what they're looking for. They only care what the minimum required payment is on the account each month. So if you make $150,000 a year salary, lenders are going to divide that by 12 months, and your monthly income considered for the DTI calculation, which is debt to income ratio, is going to be $12,500 a month. Now, 50% of that is $6,250 per month. So this means that this is the maximum monthly debt payments that you can have, and this is going to include your car payments, your credit card payments, your personal loans, your student loans, child support, things along those lines. And so the first scenario will be if we buy with absolutely zero debt. So no monthly debt payments. If you have credit cards, this would mean that you typically pay them off in full each month and no other payments. And we're also going to use a 5% down payment on a conventional loan program. And so again, the maximum debts that we can have is 50% of our income, which is $6,250 a month. And since you have absolutely zero debt, this $6,250 represents the maximum monthly mortgage payment that you'll be able to qualify for. And assuming a 5% down payment on a conventional loan, that would equate to about an $800,000 purchase price. Now, this is going to be all inclusive of your principal and interest, which would be $49.29 a month. There's going to be $150 a month in homeowners insurance. There's going to be $833 a month for property taxes, assuming a 1.25% property tax rate, and $240 a month for PMI, which is private mortgage insurance, which you're required to have anytime you put less than 20% down on a conventional loan program. Your 5% down payment on this would be $40,000, and you can expect your closing costs at this price range to be about $16,000, and that's going to include your property taxes, titling, insurance, appraisal fees, things along those lines. And so total for an $800,000 price range, you'd need about $56,000 total out of pocket. Now, the second scenario that we're going to go ahead and look at is if you made the exact same money but had $700,000 a month in debt payments, and this can consist of car payments, credit card payments, etc., or even a combination of multiple of these things, as long as the payments add up to about $700 a month. So remember, our debts cannot exceed more than $6,250 a month, inclusive of all debt. So we're going to subtract this $700,000 from this number, and that's going to leave us with $5,550 a month, which means that this is the maximum monthly mortgage payment that you'd be able to qualify for, and that would equate to about a $715,000 purchase price with the same 5% down payment. Now, this payment would include your principal and interest, would be about $4,405 a month, $150 a month for homeowners insurance, $744 a month for property taxes, assuming the same tax rate, and about $215 a month for PMI, which you're required to have anytime you put less than 20% down on a conventional loan. Now, the third scenario is if we put 20% down to avoid PMI and increase our buying power. So if we make the same $150,000 a year, that would put our income at $12,500 when divided by 12 months, and our debts can't go over $6,250 a month. And with a 20% down payment, that would mean that you'd be able to buy up to a $975,000 purchase price. So this increases your buying power by quite a bit for two reasons, really. One is you're putting more money down, and two, you're not required to have PMI, which lowers your monthly mortgage payment, which therefore increases your buying power. This payment would include $5,059 in principal and interest. We're keeping the homeowners insurance at $150 a month. Obviously, this is going to depend on what kind of quotes you're getting and what kind of coverage that insurance provider is giving you, but we're going to keep it at $150 a month for this example, and then $1,015 a month in property taxes. And lastly, the fourth scenario would be if we still put 20% down but had $700 a month in debt payments. So this would allow our maximum monthly mortgage payment to be $5,550 a month after subtracting the $700 a month in debt payments, and that would put our maximum price range at about $860,000, with your payment being made up of about $4,462 a month in principal and interest, same $150 a month in homeowners insurance, and $895 for property taxes. Now, a couple final thoughts on this to throw in here that I think are worth noting. One is that everyone's scenario is different, and although conventional mortgage guidelines are going to allow you to qualify for up to 50% of your gross monthly income, it's not necessarily guaranteed, and your lender still has to run your application through an automated underwriting system called DU or LP, and that system has to give us the thumbs up on the approval. And two is that just because a lender allows you to qualify for up to 50% of your gross income doesn't necessarily mean that you can actually afford at this price range. Remember that you don't actually see your gross income. You see your net income after any tax, any insurance payments, and retirement contributions. And I know personally, I wouldn't feel comfortable with my mortgage payment being half of my gross income, even if I had no other debts. So just make sure that you're buying responsibly. And again, like I like to say often, is make sure that you have a certain budget in mind before you even talk to a lender or a realtor to make sure that you're going to be comfortable with that mortgage payment before you actually take on something like that. So that's all I got for you guys. Hopefully this was helpful for you. If you have a specific scenario or question related to any credit, income, or assets when buying a home, feel free to put it in the comments and I'm happy to help. See you guys.